take it away.
Well, thank you, Chris, and thank you all for taking time out of your busy schedule to be with us here today. What I would like to do in the session is talk about this year's operating performance report and share with you some of the results of this year's study, which is the 2016 study of 2015 results. But also get into what we learned from this information, why it's important, and most importantly, how to apply it to your own business. Now, as Chris already mentioned, this is the 34th year that we at Industry Insights have had the privilege to be involved in producing the OPR, and I'm almost embarrassed to say that I've been there since the beginning. I think I remember Chris telling me at some other point in time that he dug up OPR reports going all the way back to the 1920s, so the association has done it for a long time, even before we were involved. But at any rate, we have been very privileged for the last 34 years. Sort of where we're heading in the session today is I want to spend just a few minutes up front getting us all on the same page as to why this information is important, what it is not, talk about what is in the report, and I think that's useful because there is a great deal of information in the OPR, and it's sometimes easy to miss some of the things that are in there and some of the things that have been added as enhancements in the last couple of years. Also make a couple comments about the economy, then get into the actual highlights of the study, and then do something that I always like to do in a session like this, and that is look at the quote-unquote profit leaders in the industry. And we define these as being the upper 50% best performing companies based on one measure, before tax return on assets. And what we do is, for each of the various segments, such as the plumbing supply firms, the PVF firms, the plumbing and PVF and HVAC companies, we separate out the most profitable companies based on that one measure, put them in a group of their own, and then run all of the measures, all the means and medians for that group of companies to try to differentiate what separated them from other companies in the industry. So the idea is, why were the winners winners? And by looking at that, you'll find out that there are certain areas that they do not do as well as other companies in the industry. But at the same time, there are certain areas that they always excel in year in and year out. So that leads us to the conclusion that if you focus on those areas of your business, you're probably going to get the greatest bang for your buck in improving your operations. I also want to make a few comments about what we've learned in 34 years of doing the study, because there has been some significant commonalities year in and year out in terms of what has led to high performance in the industry. And then finally, at the end of the session, make a few comments about how you can use this and apply it to your own business. So having said that, I would like to first of all emphasize at the outset that this study is done in strictest confidence. If you know anybody that does not participate in the OPR in any given year because they're concerned about confidentiality, have them call me. I won't bore you here with all the things that we do to ensure confidentiality, but suffice it to say that my company specializes in doing these kind of studies for many different industries. And no one at ASA, no one in the industry, no one other than select few people at Industry Insights ever see your confidential information. And even within my own company, we handle your information confidentially as much as we can. We assign a confidential code number to your company, and it's handled anonymously. Well, as a participant in the study, you actually get two separate reports back to you. You get a full industry-wide report. The industry-wide report has all of the data in it for all the data groupings, not just the ones that apply to your own business, but all the data groupings in the industry that we produce. It also has ratio definitions, some analysis, and various other information in there. Then, in addition, you receive what I consider the most significant output of this study, and that is your own company's customized, confidential, individual company performance report. This is your own company's information already calculated for you and shown alongside the data comparisons for companies most like yourself. And both of these reports are made available to you electronically now so that you can print as many copies as you want, The industry-wide report is produced so that it's best to produce it as a two-sided document, so you can save paper and also makes it easier to manage. The individual report is made available to you, and you can print it two sides, but it's mostly made available so you can just print it one side. But at any rate, you now can print as many copies as you want. Also, the individual report is made available not only as a PDF document, but also in Excel form so that you can do different data manipulations to it if you should so desire. Now, in the individual report, there are several main sections. One, there's sort of a report card type section that looks at a number of key measures and sort of rates your performance for those measures based on whether or not you are strong, good, fair, or poor, and then gives you a little assessment of what that might mean. In addition, in the individual report, there is trend information. If you have participated in this study for more than 1 year, then we can show your own company's results over time as compared to your peers in the industry. So on this chart, on a trend chart, if you have participated 5 years, like my hypothetical example here shows, then the solid line is what your company's performance was for each of those 5 years for that particular ratio. This ratio is net profit before tax to total assets, or return on assets. Obviously, this is a hypothetical company because you can see it's the exact same performance each year. In addition, on this chart, there is a dotted line, which is what the industry comparative has done for that particular ratio over those years. So you can see if you are above or below the industry comparative. You can see if the industry has trended up or down. You can see if you've trended up or down. So in a picture, you can get an assessment for how you've done for that particular measure. The shaded area then represents the middle 50%, or it's bordered by the upper and the lower quartile. So you can see if you fall within the middle 50% for that ratio also. Our sample company here has done poorly, so it's well below the median, the typical company, and it's well below the middle 50%. So that's how to use these trend graphs. Now, if you've participated 5 years, we'll show 5 years on it. If you've participated 3 years, it'll show 3 years, so however many years you have participated. Then in addition to the trend information in graphic form, the report also shows the trend information for all the various ratios in tabular form. And this is just an example where you can see, in this particular instance for my sample company, it shows that sample company's information each year over the last 5 years. And again, my sample is identical in every year, which emphasizes that this is hypothetical numbers. This is not any individual company's numbers. But in your report, it'll show your own performance over the last 5 years. So that also becomes a good comparison for you. It's good to compare yourself versus the industry norms, but it's also good to compare yourself versus your own historical performance. So if you see something that has trended up or down, then that can be a red flag as to something that you might want to improve. In addition, in your individual report, then there is your firm's information shown alongside the comparisons for all companies like yourself. Now, I've again just sort of dummied up a sample here, but there is information by type of company that you are. There's information by sales volume, size of the company you are, for the region you are in, and then your firm's information. There's various other information as well. This is just a sample, but the idea here is to try to get as close as possible to an apples-to-apples kind of comparison for you. Okay, well, why is this information important in the first place? Why do we even look at financial ratios? Well, we like to look at a financial ratio because to look at the dollar amounts of your business probably doesn't tell you all you need to know. For example, if you said, Tom, we had a great year last year, we had $1 million in profits. Well, on the surface, I don't know if that's good or bad. If you're a $10 million company and you did $1 million in profits, that's 10% profit on sales. That's pretty good. That starts to tell me something. But if you're an $100 million company and you did $1 million in profits, that's 1% profit on sales. So that starts to tell me something totally different. So that's why we like to look at a ratio rather than just looking at the dollar amounts. Well, just looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a ratio. You need some sort of comparison, some barometer. Certainly looking at your historical performance is a good comparison, but also looking at your industry peers is very useful, and that's what the OPR does. For example, if you said to me, Tom, I'm a plumbing supply company, and my payroll and fringe benefits cost last year were 20% of sales. Well, on the surface, I don't know if that's good or bad. But I do know by virtue of doing this study that the typical company was at 16.1% of sales. So if you're at 20 and the typical company is 16.1, that raises a red flag for me. So that's why it's useful to look at a guideline. So you have your industry ratios in the OPR. You also have your own historical performance, and together, hopefully, these can provide good tools to help you manage your business better. Recognizing that when you're comparing yourself versus the OPR comparisons, if you see a major deviation between you and the industry norm, that's not necessarily good or bad, but it is something that you need to understand. Maybe you are much different than a typical company, and maybe that explains why you are much different or why a particular ratio is much different. And if you know that and you understand that, then that tells me you probably are in control and it's probably not an issue. But if you are significantly different, let's say your payroll costs are significantly higher, but you have no idea why that is the case, then hopefully that'll lead you to look into that in more depth. And I maintain that even relatively simple analysis of your business can result into some significant insights about where to improve your business. Well, as I said, the report is a very detailed report. There's all kinds of different measures for many different aspects of your business. Not only profitability, but expense detail, income statement and balance sheet information, asset and financial management information, etc., etc., etc. And in an attempt to try to get as close as possible to an apples-to-apples kind of comparison, the data is broken a number of different ways. It's shown as all firms within a segment, such as PVF, plumbing and PVF, or HVAC and other. But also within each of those segments, the data is broken by sales volume size. So if you're a large company, you can compare yourself versus other large companies and vice versa. There is also within each of those segments this high profit break that I mentioned before, which is the top 50% best performing companies based on one measure, before tax return on assets. There is also information by number of branches, information by geographic region. So it's a very detailed study, and the attempt is to try to get as close as possible to an apples-to-apples kind of comparison. So when you use this information, what you should do is try to determine what data grouping is most relevant to you, focus on that first, and let that dictate other things that you might want to look at in more depth. Now, as I mentioned, the study has evolved over the years, and it's oftentimes missed as to some of the improvements each year. For example, we did a definitional change in the way that purchase rebates are handled on the P&L statement, so that now it's put as a part of gross margin up above the operating income line, where historically that was not the case. As I already mentioned, the individual report is now available both as a PDF and an Excel report, so that you can print as many copies as you want, and the industry report's also available electronically for the same reason. We added an employee turnover ratio a couple years ago. Regional information is now both in the industry report and in the individual report, and various other things happen from a year-to-year basis. We are always open to more suggestions. We want this to continue to be evolving. So if you have a suggestion, by all means shoot it to me in an email, and if we can do it, we will do it. Okay, in addition to the fact that just looking at the dollar amounts of your business doesn't tell you all you need to know, it's also important to recognize that it's very difficult to operate your business knowing what's going to happen in the economy. Now, let me say it a different way. Understanding and knowing what's going to happen in the economy is very difficult, and even the most sophisticated econometric models out there very often miss on their predictions. For example, just as an exercise, I went back and looked at 4 economic forecasting organizations, all of which use very sophisticated economic forecasting models, and try to determine how close they were in 2015 versus the actual. Well, the Conference Board said 2015 was going to be a 2-point increase in real GDP, gross domestic product. Congressional Budget Office 2.8, 3.3, 3.1. The actual increase was 2.4%. All of them overestimated it. As a matter of fact, I have found when I've done this little exercise that typically most forecasting agencies tend to be overly optimistic for whatever reason. Well, back in January of 2015, each of these same 4 projected 2016 to have these kind of increases, as shown in the second column here. But then when they went and made their forecasts in January of 2016, each of them showed a somewhat lower economic forecast for 2016. Well, if you go into the assumption that they tend to be somewhat overly optimistic, in all likelihood, growth in the economy will be somewhat lower than what they've been predicted at the beginning of this year. And as a matter of fact, the first quarter of this year had real GDP growth of only 0.8%. So my point here is, it's difficult to know what's happening in the economy or going to happen in the economy. So I maintain if you do a good job of managing your business, regardless of what's happening in the economy, you're going to get the best performance possible. And that's where the OPR comes in. It's a tool to help you to gauge your business better. And a couple quotes that I think sort of reflect this. Firms that are content to merely swing with the economy usually lose ground to their competitors even during the robust years. In my business experience, I have found that when things are good in the economy, when cash flow is good, profits are good, things are good, that's when inefficiencies creep into businesses because they go unnoticed and they don't show up until eventually an economic recession or downturn does occur. And we know that that will eventually occur. Herb Kelleher of Southwest Airlines also said the challenge for success is more than simply staying in business during economic downturns. Rather, success means maximizing both short and long-term success during any business climate. And finally, he says we manage our business in the good times like we do in the bad times. And there, I think the message is it's good to be somewhat paranoid in the way you operate your business. Okay. The way to sort of break down and use the OPR to get maximum usage out of it, I think, is to start off looking at some key measures. And these are 15 measures, all of which are in the OPR, all of which I think you might want to focus on. Now, you might have some measures that you prefer that you could substitute in here and take some of these out. But the idea here is figure out what you think is key for your own business, focus on those, and then let that dictate what things to look at in more depth. If you take that approach, you will get a significant amount of insights about your business in a very short period of time. Okay, let's look at some of the results of this year's OPR, which is the 2016 study of 2015 results. And what I'm going to do is show you a series of charts that look at one ratio. They're all going to be laid out the same way for the next several charts. So if we understand how it's laid out, you'll be able to get a good quick picture of it. This one is looking at before tax return on net worth, and it's looking at each of the last 5 years, and this is for all responding ASA firms. You can see that return on net worth actually increased for all of these years here, going back to 2011. Actually, it increased for 6 straight years, and then in 2015 we see a little downtick in terms of return on net worth for the typical company in the industry. How about bottom line profit margin as a percentage of sales? This chart pretty much mirrors the previous chart, so this really is driving what return on net worth profitability is. You can see bottom line profit margins increased for a number of years there and then downticked somewhat in 2015. Now, as I go through this, it's nice to know what the industry has done. That's useful, obviously. but what's most important is how your company compares to the companies within the industry most like yourself. Asset turnover. Well, this is interesting because this has been incredibly steady over the years. Hasn't changed in any of the last 5 years, which leads us to believe that it's been profit margin that has really been dictating where profitability in the industry is. Financial leverage has ranged between 1.8 to 1.9 times for the typical company in the industry over the last 5 years. This is a measure of how much you rely on debt versus equity financing, or how much you rely on leverage, if you will. Payroll costs. This is including fringe benefits, and it's shown as a percentage of net sales. And this is a very important measure because it ends up that payroll costs are a significant cost item for the typical PHCP distributor. As a matter of fact, payroll costs for the typical company represent over 60% of your gross margin dollars. But here we show it as a percentage of sales, and you can see for the typical company in 2015 it was at 16.1%. This is for all companies overall. And ignore the fact that somehow I got an extra bar in here for 2012. That was inadvertent. Okay, gross margin on sales. Now this is the measure that we did a definitional change several years ago. Historically, purchase discounts were not put into the gross margin calculation. They were put down below as a non-operating income item, where the powers to be that originally set up the study decided to do it that way. They felt like that was a financial decision rather than an operating decision, and at that time purchase discounts were not that significant. Now purchase discounts are very significant. So as a result, it made sense to put it as a part of gross margin. So we show gross margin before factoring in purchase discounts and also after factoring in purchase discounts. And that's what you see on this chart. And you can see in 2015 we saw a slight downtick in terms of what the typical company experienced in terms of gross margin percent. Inventory turnover. This is warehouse cost of goods sold divided by average inventory. And for the typical company in 2015, it was 3.7 times. It's been very consistent over the years. So if you're in that range, you're probably fairly healthy in terms of the way you're managing your inventory turnover. But a better measure, a measure that encompasses both gross margin and inventory turnover into one overall measure of inventory, is the measure called Warehouse Gross Margin Return on Inventory, or GMROI. What this is, basically, it takes into account that some people might be a high margin, low turnover business. Other companies might be a low margin, high turnover kind of business. But ultimately, what you want to get as is a good gross margin return on inventory. And when you see 129% in 2015, what that means is that the typical company was earning $1.29 of gross margin dollars for every dollar invested in inventory. $1.29 in gross margin dollars for every dollar invested in inventory, or in other words, they were earning 129% on their inventory investment. Okay, total operating expenses as a percentage of sales. Now where this comes in terms of importance is the fact that historically and virtually every year, the high profit companies have lower total operating expenses as a percentage of sales. Now some years there's some variation in that, but in general that separates out the high profit companies. And for the typical company in 2015, total operating expenses represented 24.1% of sales. So again, the issue is, how do you compare to this? Are you significantly higher or lower than this? And if you're significantly higher, why might that be the case? If you know the reason, and there's a good reason for it, you're probably in control and it's probably not an issue. But if it's significantly higher and you do not know why, it could be eroding your bottom line profitability. Average collection period on receivables, how long it takes you to collect your accounts receivable. That for the typical company in 2015 was 44 days, and you can see that's actually gone down a little bit from certainly from 2011. Okay, that's sort of a look at some of the key overall measures. Let's take a turn and look at some personnel measures. For example, let's look at net sales per employee. Now, this is not adjusted for inflation, so this is based on nominal dollars. But the typical company in 2015 was at $435,000 net sales per employee. So again, how do you compare to that? When we take a look at our analysis of the high profit or high performer companies, we'll find that they typically have higher sales per employee than other companies in the industry. So that becomes a critical component for success in the industry. How about percent sales change from the prior year? Again, this is based on all responding ASA companies, as we've been focusing on here. Again, this is not inflation adjusted. This is just nominal dollar percent sales change. And you can see it in 2015, the typical company had a 4.3% sales increase. So then that was somewhat below that which has been experienced in the 4 prior years. Okay, let's shift gears a little bit, and I want to talk for a moment about a good way to assess your business. Many of you have probably seen the DuPont profit model that was developed way back in the early 1900s, and it's not perfect by any means, and there's been many variations of this that have been developed over the years. But the value of it is it sort of narrows your focus as to where you might look for areas to improve your business. And what you see on the screen here is profit margin, asset turnover, and return on assets. And for your company, if you multiply profit margin times asset turnover, it will equal return on assets. Now, looking at the industry norms, it won't be exactly equal because we deal in medians, and that's the nature of medians, that it won't exactly calculate, but it's very close. But at any rate, the value of this is if you have a low return on assets, it takes you back to these 2 profit pathways as to what might have affected your low return on assets. And the top number of each of these blocks here are all plumbing supply companies. The bottom is all PVF companies. So looking at plumbing supply companies, a typical company had a profit margin on sales before tax of 4.2%. Had an asset turnover, that's sales divided by total assets, of 2.6 times. You multiply those 2 together, it's going to be somewhat close to 10.7%. For your company, it'll be exact. So the idea here is if you see that your return on assets is low, then go back and look at each of these individually versus the industry. Do you have a problem with profit margin, or do you have a problem with asset turnover? And if you have a problem with profit margin, this is affected by gross margin, it's affected by expenses, it's affected by your sales. If you have a problem with your asset turnover, this is affected by your inventory, your receivables, your total assets, and also your sales. So the idea here is it helps you to pinpoint where problems might exist and therefore where to look at in more depth. Now, you can take this a step further. This takes us as far as return on assets. We can now also factor in, we have our return on assets, we can factor in financial leverage, which is total assets to net worth, and come up with a return on net worth, a return on owner's equity, return on owner's investment. Those are all interchangeable terms. And when we do that, we can now see if leverage is a factor in terms of where your return on net worth profitability is. If we put all the 3 profit pathways together, profit margin, asset turnover, and financial leverage, we can see how it all combines to get to a return on net worth number. And again, the idea here is to try to identify where your possible problems might be if you have problems. Hopefully you're already a part of the high profit group of companies, but if you see an area, if you see a return on assets or return on net worth issue that exists, then this hopefully will help you pinpoint where that problem might be, and then take you back to all those other measures that deal with that particular area. Okay, now let's shift gears. So far we've been looking at all firms and largely. Now I want to look at some of these key measures for the four segments of the industry that we include in the OPR every year. The plumbing supply companies, the PVF companies, the combination plumbing supply and PVF, and the HVAC and other companies. Now, here we're just looking at the all firms within each of these groups. As I mentioned earlier, the data is broken down in various ways, even within each of these groups, such as, for example, in the PVF group, you have PVF companies by sales volume size. You have PVF companies for the high performer group, etc. But just looking at this is bottom line profit before tax to net worth. The most profitable group during 2015 were the plumbing supply companies. Looking at profit margin, which is bottom line profits as a percentage of sales, we can see the reason why the plumbing supply companies had the highest profitability or return on net worth profitability, and that is because they had the highest bottom line profit margin during the year. All right, gross margin, however, differed somewhat among the four groups. The plumbing supply companies didn't have the highest gross margin. That was a tie between the plumbing supply and PVF combination companies and also the HVAC and other companies. Now this is overall profit margin, or excuse me, overall gross margin. This is not warehouse gross margin, which is used in the warehouse or the GMROI, or gross margin return on inventory calculation. What you see here is overall gross margin, and this is after purchase discounts. Okay, inventory turnover, which is warehouse cost of goods sold to average inventory. So it's only inventory that is brought into the warehouse is actually warehoused. So you can see in this particular case, the plumbing supply companies had an inventory turnover of 3.9 times, PVF were at 4.0 times, which was the highest of the group. Warehouse gross margin return on inventory for the four groups, the PVF companies had the highest, and you can see the HVAC and others had the lowest. Okay, employee turnover. That's a measure that we first added a couple years ago, which gets an indication of how often your employees are turning over. And the definition of this measure is included in the full industry-wide report. But you can see that the plumbing supply companies tended to have the highest employee turnover, and the HVAC tended to have the lowest. Okay, in the study, we also do a data grouping of very large and very small companies. So if you happen to fall in either of those two segments, you can compare yourself with that segment that you fall into, which gets you again close to an apples to apples kind of comparison. On the screen here you see before tax return on net worth, and you can see that the very large companies, the companies over $10 million, by far had a higher return on net worth during 2015 as compared to the very small companies. And a big reason for that is because the large companies, for whatever reason, had a much higher bottom line profit margin on sales than did the small companies. Okay, gross margin on sales, interestingly, favored the high profit company, or excuse me, the large companies, the 100 million and over companies, but it wasn't as significant as the bottom line profit differential was. Inventory turnover also favored the large companies as compared to the small companies. Employee turnover, however, tended to favor the small companies. Turnover in the 10 million and under companies was much lower than it was in the very large companies, again, for whatever reason. But this is the third year that we've measured this particular item, employee turnover, and this is the third consecutive year that the large companies had much higher employee turnover than the other companies. Okay, as I mentioned at the outset, one of the things we like to do is take a look at the profit leaders, the high profit companies. And these are the top 50% highest performing companies based on before tax return on assets. What you see on the screen here and what you're going to see on the next several screens is a comparison for two segments in the industry, plumbing supply companies and PVF companies. And I'm going to look at a series of measures and compare all plumbing supply or all PVF versus the high profit group of companies within each of those segments. And again, the high profit group of companies is defined as the upper 50% most profitable companies based on one measure, before tax return on assets. So we separate out the top 50% in each segment based on that measure, put them in a group by themselves, and then run all the means and medians for that group of companies to try to differentiate what separated them. And looking at this particular measure, sales growth, you can see, let's go back, you can see that the high profit companies in each segment did somewhat better in terms of sales growth. Now, this isn't always true every year, but it was true this year. And then the PVF group of companies, the high profit companies, actually did much better in terms of sales growth, because all PVF companies overall actually showed a decline in terms of sales in 2015. Now, as I go through this series of slides looking at the high profit companies versus all companies overall, keep in mind that in the all companies group, that also includes the high profit companies within there. If I would have done a high profit group versus low profit group, some of these differences would be even more pronounced. Okay, before tax return on net worth, this is bottom line profits as a percentage of net worth or owner's investment or owner's equity. And the high profit companies obviously are much more profitable, because that's basically how we define them, as the most profitable group. But what's significant to me is, like, look at the PVF companies. The high profit companies are substantially more profitable than all PVF companies overall. And again, if we would have done the high profit or the upper 50% and lower 50%, that differential would have been even more pronounced. Okay, bottom line profits as a percentage of sales, or profit margin as a percentage of sales. Well, obviously this is driving the profitability. The high profit companies in each group were significantly more profitable in terms of the percentage of sales dollars they're dropping to the bottom line than all companies overall within the group. So profitability, or bottom line profit margins, is largely what's making them the high profit group of companies. Okay, let's look at gross margin, which is a piece of profit margin. Well, in the plumbing supply group, the high profit companies did have somewhat higher gross margin as a percentage of sales, and this is again after purchase rebates. The PVF companies also had higher gross margin as a percentage of sales. So in both groups, gross margin was a driving factor this year. Now, that's again not always the case. Some years we find that the high profit companies actually have lower gross margin, but in this year the gross margin was certainly a factor. How about total operating expenses as a percentage of sales? Well, in the plumbing supply group, operating expenses were somewhat lower as a percentage of sales. But interestingly, and this is somewhat of an anomaly if you go back and look at many, many years in the past, the high profit companies of the PVF group actually had higher operating expenses as a percentage of sales. Now, the 0.5% of sales higher operating expenses nowhere offset the much higher gross margin that they were experiencing, but for whatever reason, they did experience higher operating expenses for this most recent year. How about inventory turnover? Well, interestingly, in the high profit group of companies, inventory turnover was slightly less, very close, but slightly than all companies overall. In the PVF group, the inventory turnover was somewhat higher, slightly higher than all companies overall. So inventory turnover doesn't seem to be a big factor because they were very close. How about GMROI, gross margin return on inventory? Well, for both of the high profit groups shown here, GMROI was higher, indicating that the high profit companies are getting better return on their inventory investment. And in particular, the high profit PVF companies was significantly better than all PVF companies overall. So the high profit PVF companies is earning $1.71 in gross margin dollars for every dollar invested in inventory. And that was due primarily to their very high gross margin levels. All right, what about payroll and fringe benefits? Now, in the high profit plumbing supply companies, payroll costs were slightly lower, somewhat lower. Interestingly, in the high profit PVF companies, payroll costs in 2015 were higher. Again, thankfully, they had much higher gross margin, which basically offset the higher payroll costs. Again, this is somewhat of an anomaly. If you go back many years, you'll find that typically the high profit companies in any given segment had lower payroll costs. But at least in 2015, that wasn't the case for the PVF companies. Okay, sales per employee. In both groups, sales per employee was higher for the high profit companies. And this is a very common finding if you go back year in and year out. Basically, the high profit companies in any given group have higher sales per employee. They're getting more productivity out of their employee. So in this case, they're generating more sales dollars for every employee that they have in the business. Employee turnover. Well, in the plumbing supply companies, employee turnover was somewhat higher for the high profit companies. In the PVF companies, employee turnover was somewhat lower for the high profit. So that's sort of mixed. Average collection on receivables, again, somewhat mixed. The all plumbing supply companies were slightly higher than the high profit, and the high profit PVF companies were somewhat higher than the all PVF companies. Financial leverage. This is a common finding. In both groups, the high profit companies tended to have somewhat lower financial leverage than did all firms overall. So this is the total assets divided by net worth. It's the amount that you rely on debt versus equity financing, and it tended to favor the high profit companies. So what can we conclude from this? Even though there are some anomalies here and some mixed results, basically the high profit companies had higher sales growth and certainly higher profitability, no surprise there because that's how we define them. They have much higher bottom line profit margins, and this year they had higher gross margin on sales. Inventory turnover was similar. They both had somewhat higher GMROI, or gross margin return on inventory. They had higher sales per employee, or employee productivity. Essentially similar expenses as a percentage of sales, somewhat similar average collection period, somewhat lower financial leverage. It was sort of mixed in terms of employee turnover from one group to another. Well, if you wanted to sum up going back over the 34 years of doing the study, what have we learned? Well, one of the things we have learned, and this was somewhat of an anomaly this year in terms of the PVF companies, but we've learned that expense control is critical. As a matter of fact, 3 of the 4 industry segments, the high profit companies had lower expenses this year. And if you go back, invariably, the high profit companies have lower expenses as a percentage of sales. And I think one of the reasons for that is something that I've addressed in the past, and that is something called expense creep. And what that is there's a natural tendency for expenses, dollar expenses, to go up. Because rents go up, you want to give your employees raises, and basically expenses tend to go up. Even when sales tend to be flat, expenses tend to creep up. And as I alluded to earlier, what I have found is when sales are going good, when cash flow is good, when profit's good, that's when expense creep really starts creeping in. That's when inefficiencies really start creeping in and go unnoticed until an economic downturn hits. So expense management is something that you really need to focus on if you want to be a high profit company. And in the OPR, there is a fair amount of expense detail for you to look at. So if you see your total operating expenses being high, you can look at it by department to try to pinpoint down where the issue might be. Or you can look at payroll costs and fringe benefit costs and start pinpointing where the possible problem might be, and hopefully that leads you to the solution. Now, in addition, one thing we have learned, and that is gross margin is important, but it's not the only name of the game in terms of inventory management, because inventory turnover is also important. And this is a chart you may have seen me show before if you've seen any of my sessions, but this emphasizes the importance of both the combination of gross margin and inventory turnover. Let me just take you through it. Let's say you start off with $10 million of cash. And since you're in business to make money, you're going to use it to buy products. So now you have $10 million of cost inventory. You mark it up. We'll say you mark it up 20%. Now this isn't gross margin. This is just markup. So now you have something called inventory for resale, which is $12 million. Hopefully you sell it. If it was all a cash sale, which is very unlikely, it would all go back to the top as $12 million of new cash. Most likely it's going to be a credit sale. It's going to become an accounts receivable of $12 million. Hopefully eventually it's collected, so now that $12 million goes back to the top as $12 million of new cash that can be put through the cycle. So the idea here is the more times you can put it through the cycle, other things being equal, then the more successful you're going to be. If, however, it gets stuck right here as inventory for resale that's not selling, then that's money that's not going through the cycle, not growing for you, crimping your cash flow, and hurting your profitability. Similarly, if it gets stuck as accounts receivable, the same thing. It's going to hurt your cash flow and hurt your profitability. So putting it through the cycle represents turnover of both inventory and turnover of receivables. But obviously, the name of the game is not just turnover. It's the combination of how much you're marketing up or what your gross margin is going to be, as well as turnover. So that's why we look at that measure, gross margin return on inventory. But when you look at this, you might want to show this chart to some of your vendors, because if they load you up on inventory and it becomes inventory that's stuck for resale that doesn't sell, it's going to hurt you. So you might have that discussion with them before you get loaded up with inventory. Well, we have these inventory management measures that we've already taken a look at that get you an idea for how well you're managing your inventory. Warehouse gross margin as a percentage of sales, inventory turnover, and GMROI, or gross margin return on inventory. Also, if you have inventory that's not selling, it's not only costing you and hurting your cash flow, but it's also costing you money in terms of inventory carrying costs. And what I've done is listed here some samples of what you might start tallying up as inventory carrying costs. And these aren't necessarily perfect. These are just sort of estimates. But the bottom line is, depending on what numbers you put into these various things, it may very well be that excess inventory is costing you as much as 20 to 25% of the value of the inventory. So said another way, if you have $100,000 of excess inventory, that might be costing you $20,000 to $25,000 just in inventory carrying costs alone. So it doesn't not only crimps your cash flow, but it also hurts you in other ways as well. We can also measure receivables. As I mentioned, it's important to turn over your receivables in that chart we just looked at, and we have average collection days or average receivable days outstanding as a way of measuring your receivables. You also can produce aging schedules within your company that shows the percentage of your accounts that are current, 30 days past due, 60 days, etc. And that's also very useful to do. Now, basically, there is no mystery to measuring receivables. or managing receivables. It's a matter of measuring and being aggressive in the follow-up. Personnel management, also a critically important component that separates the high-profit companies from other companies in the industry. And I put out to you that if all employees are simply salaried, where's the incentive to produce? If all of your sales staff are based on commission based on gross sales, where's the incentive to be profitable, to produce profitable sales? Well, one thing we do know is that high-profit companies historically and consistently have a higher employee productivity than lower-profit companies. And sales per employee is usually always higher for the high-profit companies. Payroll costs oftentimes are lower for the high-profit companies, even though they typically pay their people more. But personnel productivity definitely favors the high-profit companies. Well, another chart that I'd like to briefly explain that is in the OPR each year is something called the sustainable growth rate. And this will only take me a minute. The sustainable growth rate is a simple little measure. It sounds like a theoretical thing, but it's a simple measure. All it tells you is how fast your company can grow through internally generated funds without having to go outside to seek outside financing, such as new debt or new equity financing. I can't tell you how many times I've had people say to me, Tom, my sales are up, my profits are up, but I have no cash. I have no cash flow. Well, the reason probably is because they are growing faster than their sustainable growth rate. And all the sustainable growth rate is, it's your net profit after tax minus your dividends, how much you're taking out in dividends, over your net worth. So basically, profit after tax minus your dividends over net worth. Or another way of looking at it is net profit after tax to net worth times the percent of profits taken out at dividends. Best looking at an example. If you have a company that has $5 million in profit, the owners are taking out $2 million in dividends, they have $50,000 in net worth, then they have a 6% sustainable growth rate. So what that means is, if they are growing faster than 6%, like 10%, then over time, if that persists, they're going to need new financing, either new equity or debt financing, because they just won't be able to sustain the growth. Because with growth comes new responsibilities, like more inventory, more receivables, more people probably, more facilities probably. If, on the other hand, you're growing slower than your sustainable growth rate, then probably that means that you have a lot of excess cash. So that's all the sustainable growth rate tries to tell you. One last comment I'd like to make. In this year's study, there's a little article on innovation versus efficiency indicators. And the main gist of this article is the fact that the OPR is oftentimes, I think, always looked at as a tool to help you to be more efficient in the operating of your business. And it certainly is that. But it's more than that also. It's also sort of a tip to you as to when you need to innovate rather than simply be more efficient. So when you need to innovate rather than tweak, if you will. So the idea here is that if your company is always a high profit company and you're sustaining that over time, then that means that you might just want to tweak or innovate. On the other hand, if your company is a low profit company and maybe even going down, then you may need to do more than just tweaking, more than just looking for ways to be efficient. You may need to do something innovative. You may need to do something dramatic. And if you read that article, it gives you some tips on sort of how to think that through. And I would just suggest you might do that, because the OPR is much more than just a tool for helping you to look for ways to be efficient. It's also a way for you to help you to look for ways to innovate your business. So just to summarize, in using this, start off looking at some key measures, those 15 measures. Look at the data grouping, most like yourself. If you want to get more sophisticated, look at yourself versus the profit leaders, and recognize if you see big variances, they're not necessarily good or bad, but they're tips for things to look at in more depth. Again, here are the 15 measures I recommend. You may have some favorite measures that you can put in or take out, but these are the ones that I would start off with. And finally, you have two separate reports, and the individual report, the report on the right, is the one specifically about your business. To me, that is the reason for participating in the study. And then if you wanted to narrow down where to focus your efforts, focus the efforts on the things that have made the high profit companies the most profitable. Things such as expenses, inventory management, receivables management, and personnel management. If for some reason you didn't get your report, it's accessible through the login information that you see at the bottom of the screen here. I would recommend that you, if you didn't, either contact me or my assistant and we'll help you get your information.